It's been more than a decade since Mt. Gox collapsed, and in 2024 and 2025, creditors are finally receiving part of their Bitcoin back. But if you're in the US, the real question is, what does that mean for your taxes? I'm Andrew Gordon with Gordon Tax, and I've helped thousands of investors and businesses navigate crypto taxes. Let's start with a little history, and then let's look at what's happening now with Bitcoin and Bitcoin Cash, and finally break down the tax implications, including how to handle the gains, losses, and your cost basis. Back in the early 2010s, Mt. Gox was the Bitcoin exchange. At its peak, it handled around 70% of all Bitcoin trades worldwide. But in 2014, it collapsed after hackers drained hundreds of thousands of Bitcoin from the exchange. Over 120,000 customers lost access to their coins overnight, and for years it looked like they'd never see them again. But in the bankruptcy process, roughly 200,000 Bitcoin were eventually found in old Mt. Gox wallets. As Bitcoin's price surged over the years, the value of those recovered Bitcoins ballooned. That set off a decade of legal battles about how to distribute them. After all the waiting, 2024 and 2025 are finally the years that creditors are getting paid. So what's actually being paid out? Creditors are receiving distributions in Bitcoin and Bitcoin Cash. If you were a Mt. Gox customer, you might only get about 20% of what you originally had. For example, if you had 10 Bitcoin back then, you might receive around 2 Bitcoin now, plus the equivalent amount of Bitcoin Cash from the 2017 fork. Bitcoin Cash is included because when Mt. Gox's Bitcoin was held in trust, the 2017 Bitcoin Cash fork created an equivalent number of BCH coins. Those are now being distributed alongside Bitcoin. No one is made whole, with most creditors getting only a fraction back. But because Bitcoin's price skyrocketed compared to 2014, what you recovered today may actually be worth far more in dollar terms than what you put in. And that's where the tax questions come in. Here's the key thing. Getting Bitcoin back is not taxable itself. You already own those coins. They're just locked up. When the trustee transfers them to you, it's not income. It's simply a return of your property. Your cost basis carries over from when you originally bought them. Now, let's use a simple example. Say you had 10 Bitcoin on Mt. Gox in 2014, bought at a total cost basis of $5,000. After the collapse, you're getting about 2 Bitcoin back. Today, those 2 Bitcoin may be worth around $200,000. From a tax standpoint, here's what happens. You allocate 20% of your original $5,000 basis, or $1K, to the 2 Bitcoin you got back. You now hold 2 Bitcoin with a basis of $1,000 total. And when you eventually sell them, the IRS will tax the difference between your sale price and that basis. Because you originally acquired them over 10 years ago, they qualify as long-term capital gains, which are taxed at favorable rates. So in our example, if you sold both Bitcoin today for $200,000, you'd have a taxable long-term capital gain of about $199,000. Now, what about the other 8 Bitcoin you never got back? That's where losses come in. You still have $4,000 of basis tied up in those unrecovered coins. Once the rehabilitation process finishes, you can claim that as a capital loss. That loss can offset your other capital gains, and if you have more losses than gains, up to $3,000 can offset ordinary income each year, with the rest carrying forward. Here's the educational point. Mt. Gox creates this unusual situation where you may have both a huge long-term capital gain on the recovered portion and a deductible loss on the unrecovered portion. The gains won't hit until you actually sell your recovered coins, but the loss on the unrecovered coins can be taken once the process is final. And the Bitcoin Cash? That's trickier. The IRS says that forked coins are taxable as ordinary income when you gain control. That means the Bitcoin Cash you receive in 24 or 25 may need to be reported as income at its fair market value at receipt. That amount is usually much smaller compared to Bitcoin, but it's something you'll need to handle correctly. So how do you actually claim those losses? First, document your original purchase history. Even old exchange receipts or bank statements can help establish your cost basis. Second, once the settlement is complete, figure out how much of your original claim was permanently lost. Third, Report that portion as a capital loss on Form 8949 and Schedule D. Make sure to note that it relates to Mt. Gox, so you have a clear record if the IRS asks later. If you can't reconstruct your records, you may have to take a conservative approach and assume a very low cost basis. But if you can substantiate what you originally paid, you'll be in a much better position. The Mt. Gox settlement is a once-in-a-decade event, and it's also one of the most complex crypto tax situations investors will ever face. You've got return of property, capital gains, deductible losses, forward coins that may be ordinary income, all in one package. And if you get this wrong, you could either overpay in taxes or invite unwanted IRS attention. That's why it matters to understand not just the mechanics of the payouts, but also how the IRS sees them. Proper planning can mean the difference between a smooth return and a costly mistake. If you're a Mt. Gox creditor in the US, don't go at it alone. At Gordon Tax, we're focused in crypto tax strategy and compliance. We'll help you allocate your cost basis, report gains and losses correctly, handle Bitcoin Cash income, and maximize deductions you're entitled to. So if you finally received your payout or you're expecting it this year, reach out to us. The link's in the description, and if you found this helpful, hit like, subscribe, and drop a comment below, especially if you're one of the original Mt. Gox users getting Bitcoin back after all these years. We'd love to hear your story.